good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, earnings season is in full gear, and today we're taking a look at one of the largest financial services groups in the Caribbean and its investee company. We're talking, of course, about NCBFG or NCB Financial Group and Guardian Holdings Limited, NCB for its half year ended March, and Guardian Holdings Limited for its first quarter ended March 2022. Both companies would have reported increases in earnings. Let's take a look at how they would have fared and what investors could expect in the months ahead. Turning firstly to NCB Financial Group or NCBFG. Well, the group did report an earnings per share figure in the equivalent TT dollars of 20 cents per share, an 83% increase, a whopping 83% increase from the 11 cents per share reported in the prior comparable period of the half year fiscal 2021. Now, banking activity results was very impressive, up 14.6% from 2.04 billion TT equivalent to just around 2.34 billion TT equivalent. Overall net operating income was up 16% from 2.6 to just over 3 billion TT dollars equivalent, and ultimately net profit attributable to equity holders or shareholders up 77% from 258 million to just around 457 million TT dollar equivalent. So certainly from an earnings perspective, a very impressive performance period over comparable period for NCBFG. When we take a look at some of the net operating income performances by segment, well, it was generally a very positive comparable period with net interest income over that half year 2021 to half year 2022, increasing 20% from 1.187 billion to just around 1.4 billion, again a 20% increase. Net results from insurance activities also improving 20% from 576 million TT equivalent to just under 700 million TT equivalent. Net fee and commission income up just around 15% from 495 million to 567 million TT equivalent in that yellow segment. The only major decline noted was that gain on investment and FX activities from 369 to 237 million, or roughly 55% decline. So some challenges there, and it certainly has been a very volatile period for financial markets, as investors would note, and that is being reflected in the performance of not just NCB, but multiple financial services companies in that particular segment. Now, when we take a look from a shareholding perspective, well, valuations for NCBFG with its latest earnings performance have moderated and are now back from a price earnings ratio perspective in that 15 to 17 times range, which it has historically been in over the past five historical periods of HY20 or half year 2018 to half year 2020. And we can see that on a trailing earnings per share basis, still not quite up to the heady heights of the fiscal half year 2019 and 2020, where it was just under 50 cents TT equivalent per share, but certainly recovering from that half year period of 2021 of 29 cents on a trailing basis to 37 cents, which is comparable to the half year performance of HY or half year 2018. So when we take a look at a price of $6.05, NCB, as mentioned, is trading at that 16.7 times price earnings ratio, which is pretty comparable to the banking sector average of 16.8 times. However, it does offer a fairly uninspiring dividend yield at this point in time of 0.4% compared to that 2.5% banking sector average. So on the basis of improving profitability and fair valuations, but cognizant of those volatile financial markets and its potential impact on earnings of NCBFG rather, in subsequent periods, Bourse is going to maintain a market weight rating on NCBFG. Turning very quickly to Guardian Holdings and its parent company, who we would have covered recently, or just prior NCBFG. Well, GHL would have reported an earnings per share figure of 77 cents per share, which is a very modest 1.3% increase from the $0.76 or 76 cents per share recorded in the prior comparable period. And of course, we're looking at first quarter versus first quarter performance. Net income from insurance activities positively was up 27.7% from 208 to 265 million. Net income from all activities, however, was up just a marginal 6% from 577 to 611 million TT equivalent. Ultimately, profit attributable to equity holders increased just at 1.9% from 176 to 179.4 million. When we take a look at net income by activity for GHL, we can notice that there was that improvement in net income from insurance activities, moving from 208 to 266 million. There was a decline in net income from investing activities, however, an 8.1% or decline from 332 to 306 million over those quarterly comparisons, and net income from brokerage activities increased just around 10% from 37 to 41 million. Again, looking at a shareholder and value perspective, we can see that despite the 10% decline year to date in GHL's trading price, that trailing decline or trailing 12-month decline in earnings per share has pushed valuations up to around 8 times in terms of a price to earnings ratio, which is a little bit above the trading range over the past few comparable periods, where it has trailed within the 6 to 7.5 time PE range or price to earnings range. So at a price of $27, Guardian is trading at that 8 times multiple, pretty much in line with the sector average, but it does offer an above sector average dividend yield of 2.6% compared to that 1.9% non-banking finance sector average. So with those fair valuations, but cognizant of that fall in net income from investing activities, and of course, the impact of volatile financial markets on subsequent investing or subsequent financial reporting periods, Bourse is going to maintain a market weight rating on Guardian Holdings for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773. Email us at invest@boursefinancial.com. And you can check out our website where all of our research is absolutely free at bourseinvestment.com. Have yourself a safe investing week. Stay safe, get vaccinated, and see you next time on the Bourse Report.